There was rumors that France and Italy were in talks with Iran about safeguarding, getting safe passage through the strait. So they could be talking about that, paying in yuan. That would really be big news, I would say, even though I think the news from the last few days is quite important already. And I think the markets, they're kind of down. They're not really seeing this yet. And when they do, I think, gold and silver are going to go right back up very quick, just as quickly as it came down.
The global monetary landscape is shifting as rumors emerge regarding France and Italy negotiating safe passage through the Strait of Hormuz with Iran. Most significantly, these discussions potentially involve bypassing the US dollar to settle payments in Chinese Yuan, a move that would signal a massive blow to petrodollar dominance. While the broader markets have yet to fully price in this geopolitical realignment, the transition toward a gold-backed multi-currency system is accelerating. As these maneuvers become public, the temporary dip in precious metals will likely reverse violently, sending gold and silver back to record highs as investors flee crumbling fiat structures. MarioInnecco, a prominent financial researcher and macroeconomic commentator, highlights that this organic move toward the yuan and physical gold reserves is part of a multi-year preparation for the end of the dollar's hegemony. He emphasizes that as BRICS nations and European powers seek energy independence through alternative settlement systems, the intrinsic value of hard money will be the only remaining anchor for global trade. This dislocation between paper markets and physical reality represents a unique window for those watching the king anti-fiat assets. Now, we present the clips from MarioInnecco's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I said earlier that South Korea is looking to buy oil from Russia, so I wouldn't put it out of the realms of possibility that Japan might want to buy oil in yuan. That sounds a bit like quite radical, but who knows? Japan depends a lot on its energy, depends on oil coming from the Middle East, and even Europe. Who knows? Like a week or 10 days ago, there was rumors that France and Italy were in talks with Iran about safeguarding, getting safe passage through the strait. So they could be talking about that, paying in yuan. That would really be big news, I would say, even though I think the news from the last few days is quite important already. And I think the markets, they're kind of down. They're not really seeing this yet. And when they do, I think, gold and silver are going to go right back up very quick, just as quickly as it came down. I think the focus is still a lot on this, how the central banks are going to have to raise rates, that inflation is going to pick up. But the way I see what's going on with energy prices going up, and all prices are going to go up because energy affects everything, is not really inflation. It's just prices rising. Inflation, as we know, Elijah, is the creation of currency and credit out of thin air. And I think even though central banks might hold off cutting rates because of prices going up, I don't see them hiking rates because all these higher prices that we're going to see, and they're going to act like a rate hike themselves. They're going to slow down the economies. I mean, the U.S. economy was already slowing down before the war. GDP last year ended the fourth quarter only growing at 0.7. We've seen the jobs data come down, non-farm payrolls. So, that's how I see it. And eventually, I think the central banks are going to have to step in and actually cut rates or announce more QE. So whatever happens, I think they're going to have to keep inflating the system. I think it's because the algorithms and people in the markets, they view this as bullish bullish for, not bullish, bullish for rates, that they're going to go up, and that it's negative for gold and silver, higher interest rates. But I think if you look at the bond markets, yields are going higher not because the Fed's going to raise rates, but because the economies are going to slow down, tax receipts are going to go down. And with national debt just having gone through 39 trillion, and with the U.S. Defense Department, or the Pentagon or Department of War, just asked for another 200 billion extra to fight this war, the fiscal situation is going to get worse. So, and I think that's why bond yields are going up, and that should usually be bullish for gold and silver, like you say. But I don't think these algorithms, the way they've been set up, they've been set up to say bond yields up. That means real interest rates are higher. Sell gold, sell silver, right? Economy is going to a recession. That means lower prices, but it might mean lower prices for discretionary goods and luxury goods, but not for general necessities and hard assets and energy. So that's why I think the markets are mispricing. Markets are not perfect, and that's why there are opportunities, and I think this is one of them. That's the inflation, you see, and that happened in the beginning of COVID, during the Trump administration, and I think maybe the Biden administration. You might know better than I do. They sent checks as well, but then the prices started rising in 2022, 2023, and people called that the inflation. No, that was the consequence of the inflation, higher prices. That's how people pay back eventually in higher prices. And I think we're about to pay back even more now, not just because of this war and what it's done to the energy sector, but also because of the way governments have, especially the U.S. government. Don't forget the big beautiful bill, right? That's supposed to be paid for by a growing economy, an economy that's growing faster than the debt. But if we go into recession now, and if the Department of War wants another 200 billion, that's going to make the fiscal situation a lot worse, not just for the U.S., but I would say it would spill over to the whole world. And I'm looking here at the government bond yields, for example, here in the UK. Yeah, they're breaking out. It doesn't look good. So, of course, they're going to blame this war for it. But ultimately, I think it's the debt, the government debt that we keep incurring. And like you said, whenever there's a crisis, the only thing they knew that governments and politicians know to do is to spend more and help. Yeah, they're not like Ron Paul, right? Ron Paul says, I'm not going to help. But that's unfortunately, Elijah, the way our political system is set up.
The global financial landscape is shifting toward a radical new reality as nations like South Korea, Japan, and members of the European Union explore purchasing energy in yuan to secure safe passage through critical trade straits. This transition marks a definitive move away from petrodollar dominance, yet the broader markets have failed to price in this systemic realignment. While rising bond yields are traditionally viewed by algorithms as a signal to sell precious metals, the current surge actually reflects a deteriorating fiscal situation and a slowing economy rather than true economic strength. With the national debt surpassing $39 trillion and massive new military spending requests, the fiscal deficit is widening at an unsustainable pace. Higher energy prices are acting as a secondary rate hike, further stifling GDP growth. As tax receipts fall and the debt-to-GDP ratio worsens, central banks will eventually be forced to pivot toward rate cuts and further currency debasement. This mispricing offers a strategic window for hard assets. Let's get back to the interview.
Yesterday morning London time, gold was just above 5,000, and I saw this afternoon it got down to just above 4,500. So that's like a 10% drop in like just over 24 hours. And silver as well. I think we were testing 80 all of last week, and today I think we got down to 65, and now we're at 70. So a lot of volatility. What do I think is going on? Well, I think this is pointing to some kind of crisis upcoming. I don't know what it's going to be. And I think there's a lot of positioning by the big, the big boys, which I mean like the big bullion banks. Maybe they know something we don't. And I also think, Elijah, there's a lot of speculators and traders who probably actually have never held a gold coin or a gold bar, and they went all in at the outbreak of the war about 20 days ago now, thinking, gold and silver are going to go through the roof. It's war. And it did the first day, but ever since then, it's been coming off. And I think they probably given in. So it's not really, I wouldn't say it's long-term stackers and believers in sound money that are getting rid of their gold and silver, because I always ask myself, because I've been through a lot of these moves. I've been stacking for over 20 years, and I always ask myself, what would I do if I exchange all my gold and silver for fiat currency? Would I feel comfortable having all my savings back in the banking system? And I always come to the same conclusion, no. So I think that's what's happening. I think if you look at the longer term charts, it doesn't really look that negative. And if anything, it's always good for markets to, they never go up or down in the straight line. And I think there's a lot of, how can I say, negative sentiment right now, even though gold year to date is still up. I think we closed last year just above 4,300 or 4,200. Silver's kind of unchanged now. So that's how I see it. And I don't think, we can segue now into other topics, especially the war, and why I think the fundamentals are getting even better, not just for precious metals, but hard assets in general. The petrodollar is not really a system, but what the petrodollar does, that creates demand for U.S. dollars and U.S. treasuries ultimately, because most countries, treasuries in most countries, when they accumulate dollars, they turn that into T-bills or short-term treasuries or long-term treasuries. So all that will do is that's gonna equate into less demand for dollars and treasuries. And I think we're already seeing, Elijah, since 2022, a lot of these countries have been accumulating gold. And I think they're going to accumulate silver. And I think the yuan will be the major, you could call it a petro yuan, but ultimately I think China knows that not backing the yuan with something like gold or silver will create the same problem for that the U.S. has had with the petrodollar. I think it's just going to be kind of a gold standard system, so to speak, even though the yuan will be the major reserve currency. I think it's not going to be, let's say, Chinese government bonds that are going to be used. It's going to be gold. And that's why China has been basically working on growing the Shanghai Gold Exchange, the Shanghai Futures Exchange. And I've spoken about that for the last 5-6 years, that this is all a preparation for the end of the petrodollar, so that foreigners, for example, can go with their yuan and then exchange them for gold at the Shanghai Gold Exchange. And then when they have their gold reserves, they can go and trade with anyone they want in other currencies. So that's the system I see. It's not going to be a kind of a system. It's just going to be organic. People are going to trade in their own currencies. And from what we've heard about the BRICS, they want the BRICS countries to back their currency like 40% with gold. And we've even seen Poland recently say that they want to go to a 40% backing. So that's how I see it. I don't see it being like a Bretton Woods system run by one country, even though China is going to be the dominant country. That's how I see it, yeah.
The extreme volatility witnessed in the precious metals markets, where gold dropped 10% in a single 24-hour window, signals a deeper systemic positioning by institutional bullion banks rather than a shift in long-term investor sentiment. While short-term speculators who chased the initial outbreak of war are being flushed out by the current price action, the fundamental case for sound money has never been stronger. Long-term stackers understand that exchanging physical gold and silver for failing fiat currency offers no true safety within a fragile banking system. The broader macroeconomic reality is the accelerating demise of the petrodollar and the rise of a gold-backed trade settlement system centered around the Shanghai Gold Exchange. China is strategically positioning the yuan as a major reserve currency, but unlike the debt-based US dollar, this new architecture is designed to be backed by physical gold reserves to avoid the pitfalls of unbacked fiat. With BRICS nations and even European countries like Poland aiming for substantial gold backing of their reserves, we are witnessing an organic return to a global gold standard. Despite the temporary paper market volatility, the shift toward hard assets is an inevitable consequence of the current global fiscal crisis. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by liking this video and subscribing to our channel for more financial insights. Don't forget to hit the notification bell so you never miss an update. Thanks for watching.